Yeah, look, markets continued the trend that we'd seen since mid-February. We had that terrible start to the year, 6 weeks when markets were falling very sharply. A big recovery in March, and then again, continuation of the recovery, a little bit more mixed, not nearly as dramatic as the big moves we saw in March, but certainly making upward progress. So equity markets generally up 1.5%, something like that. MSCI World Index up 1.5%. Significant part of that came from currency moves. So the weakness in the dollar, which we'd seen earlier in the year, continued, and the US dollar now on a trade-weighted basis down 6% so far this year. It's a big fall. And obviously that helps returns when you're investing in euros and yen. The yen was up 6% in April. Credit also did well in the month. Both investment grade and high yield bonds performed very well. Emerging market debt did well. And in fact, those three areas have been the strongest sort of broad sectors in terms of performance so far this year now. Whereas in contrast, in April, safe haven government bonds, we saw yields go up a little bit. So actually we had negative returns from those safe haven areas. Long overdue. We've always talked for some time about the overvaluation of those markets. So it was a continuation of the trend, but I'd say as we were getting towards the end of the month, a little bit more uncertainty creeping into markets. So we've had a very big rise from those sharp falls. And in fact, looking at where markets are today, most markets have recovered the ground that was lost in those first 6 weeks. So as at today, the MSCI World Index is up about 1% so far this year, and emerging markets up 5 or 6%. Well, I think oil was again a very significant influence on the market in April. We had a close to 20% rise in the oil price in the month, and that incidentally was followed by quite a lot of commodity markets, not quite as extreme as that, but industrial metals like iron ore up 10%. Precious metals, the gold price was up 5 or 6%. But I think the oil price has been absolutely critical in determining the direction of markets for some time now, because that sharp collapse in the oil price, although it benefits the consumer in the developed world, it's hit oil producers extremely hard. It's affected the credit markets, the high yield bond market, where there's a big exposure to energy. It's affected bank loans. Banks have lent a lot of money into the energy sector, so there's defaults coming there. There have been defaults. There's more coming. So that's been a negative factor. When the oil price goes up, it eases all those concerns. So that's definitely been a very significant help. And it's beginning to look to me as if we've seen the bottom in the oil price. I think there was an interesting move in the oil market after the failure of the meeting in Qatar in mid-month, when certain OPEC and non-OPEC producers met to try to agree on a production freeze. They couldn't agree, but the oil price actually continued to go up despite that. And I think what the oil price is looking at is the likelihood now that come the end of this year, early 2017, supply and demand to be much more in balance. We're seeing shale production falling in the States. We're seeing global demand for oil growing up, so that excess supply that we're living with at the moment is probably going to be gone by the time we get into the first half of next year. So the oil price, I think, we've seen the bottom, and I think we're now going to look at a price range of more like 50, 55 as a sort of more like an equilibrium level over the next 12 months or so. So I think, in a funny sort of way, that's actually been very supportive of markets, that pickup in prices in the course of the past month or so. Well, the fear of investors, and one of the reasons why markets were so weak in the early part of the year, was this slowdown that we saw in global growth, the fear that China was going to go into a much steeper slowdown, US was steadily slowing, fear of a recession. It's fair to say the data has been somewhat patchy, but evidence has come out over the course of the past month or so that in fact the global economy is on track for its 2.5% to 3% growth this year. There's been an infusion of credit into the Chinese economy. That's definitely helping. So we saw GDP growth at 6.7%. It's probably going to be about that sort of level in the second quarter. The US, as we expected, saw a sort of pretty flat quarter of growth, 0.5% growth, but the data is still okay. So it's okay for growth of about 2%. Europe's picked up a little bit. European growth is running at 1.6% this year. So it doesn't sound great, but it's a lot better than it was. So generally speaking, I think we're getting through that sort of soft patch. Economies are not racing away, but the big concerns about further downturn in growth and then the impact on corporate profits that would have, I think are being sort of dissipated to some degree. Corporate profits are under strain. In the US in the first quarter of this year, we're seeing growth of earnings down 5 or 6%. Much of that coming from the energy and materials sector, but even excluding that, growth has been slightly negative in terms of earnings. So this is a tough period, as we've said for some time, for the corporate world. But it's not getting any worse, and if anything, it's ticked up a little better, which has been the support to markets in the course of the past couple of months. Well, central banks for quite some time now have been really the sort of the dominant influence on markets. This month we saw the ECB setting out its corporate bond purchase program, very substantial. It's going to continue for 9 months. That's definitely going to keep yields low, going to underpin asset values in Europe. It's a huge program. The Fed, on balance, slightly less dovish. The economy's picked up a little bit, not quite as negative about the global situation as they were. And I think still on track in their minds for a couple of rate rises this year. Not the market's mind, and the market's not expecting that, but certainly wouldn't dismiss that. But I think the big one was the Bank of Japan. Given the fact the economy has been weak, consumer spending weak, the yen's been very strong, all the things that RBA reforms were supposed to address, there was an expectation the Bank of Japan would ease further. It did not. So what happened? The yen actually strengthened again, and the stock market fell pretty sharply. So far this year, the yen is up 13% against the dollar. It's an extraordinary move. So there was a lot of disappointment from investors about the Bank of Japan. But the fact is they're still spending a huge amount of money buying assets. Interest rates are negative, and they could well extend that program during the course of this year. So on balance, I'd say the Bank of Japan was the big influence in this last month. But we do need to see that yen weaken, dollar strengthen to get the stock market in Japan moving up again. Well, we've had a very sharp recovery in markets from the lows of early February, and as I said earlier, really over the course of this year, if you looked at the figures of 1st of January and today, you wouldn't think that markets had that big dip, of course. So they had the big recovery. Valuations are by no means sort of cheap at these sorts of levels. And I think we face a period here of some consolidation. There are some concerns still about growth. We've still got issues about the debt problem. We've got concerns still in some of the emerging countries of the world. China's still an issue. Will the rebalancing program work successfully in the longer term? So there are those sort of negatives underpinned by this incredible support from the central banks and still ongoing growth from the economy. But I think you've got those sort of competing forces on markets. Having had a sharp rise, I think we now face a period of consolidation. The other thing I think that I wouldn't be at all surprised to see is the market beginning to feel that maybe the Fed needs to focus a bit more on inflation. Core inflation has picked up in recent months, and whilst the market is almost complacent at the moment about rate rises this year, at some stage that's going to come back, and I think the Fed is going to raise rates. Certainly not in June, I don't think that's on the agenda, but sometime later this year the market will focus on that. I think we could then see the dollar picking up a little bit. That provides more of a headwind. So I'd say in the short term, for a month or two here, period of consolidation, progress still to be made over the next 12 or 18 months, but we've had a tremendous rise. So actually a little bit of backing and filling from here.